By late 2025, China has quietly become Venezuela's economic lifeline in ways that go far beyond simple loans or trade deals. This is a strategic bet on a scale that most analysis misses, a bet that could reshape global energy markets and geopolitical alignments if it pays off, or become one of China's most expensive foreign policy failures if it doesn't. The numbers are staggering. China has invested an estimated $60 billion to $70 billion in Venezuela over the past 15 years. 60 to 70 billion loans, oil for loan arrangements, infrastructure investments, joint ventures, equipment purchases, direct support to Venezuelan government and state oil company PDVSA. Most of this money was lent or invested when oil prices were high and Venezuela looked like a reasonable bet. But Venezuelan economy collapsed. Production fell from 3 million barrels daily in the late 1990s to roughly 700,000 to 800,000 barrels daily by 2024-2025. Hyperinflation destroyed the economy. Millions fled as refugees. The country became basket case. And here's the critical point. China kept lending even after the collapse became obvious. Through 2018, 2019, 2020, 2021, when everyone could see Venezuela was failing, China continued providing support. Not because Venezuelan prospects improved, but because China had so much invested already that walking away meant losing everything. By late 2025, China is Venezuela's largest creditor by far. Venezuela owes China an estimated $15 billion to $20 billion or more, depending on how you calculate obligations and oil deliveries. This debt will never be repaid in cash. Venezuela has no money. The only way China gets anything back is through oil. Venezuelan crude delivered to Chinese refineries at discounted prices, hopefully for decades, until the debt is worked off. But here's the gamble. Venezuelan oil production needs to increase significantly for China to recover its investment. Current production of 700,000 to 800,000 barrels daily is insufficient. China needs Venezuela producing 1.5 to 2 million barrels daily or more sustained for years to make the math work. And getting Venezuelan production up requires massive new investment, billions more, into oil infrastructure. That's decayed from years of underinvestment and mismanagement into a country that's politically unstable and economically dysfunctional, with a government under U.S. sanctions making operations legally risky for Chinese companies. China, by late 2025, is doubling down, not cutting losses, doubling down. Additional Chinese oil service companies deploying to Venezuela. More Chinese technical expertise, more Chinese equipment, more Chinese financing, all betting that Venezuelan production can be revived and that China will eventually recover its 60 billion to 70 billion investment plus profit. Think about what it means when you've invested so much that walking away loses everything. So the only option is investing more and hoping the bet eventually pays off. So here's the question that reveals the scale and risk of China's Venezuela gamble. Why is China, by late 2025, continuing to increase investment in Venezuela despite 15 years of losses, despite Venezuelan production remaining 75% below peak, despite U.S. sanctions complicating operations and despite obvious political and economic risks, unless Chinese strategic calculation is that losing the $60 to $70 billion already invested is unacceptable, that Venezuelan and oil reserves of 300 plus billion barrels are too valuable to abandon, and that China has no choice but to continue betting on eventual Venezuelan recovery, even if timeline and costs are uncertain. And what are the global consequences if China's bet succeeds in reviving Venezuelan production, or if it fails, leaving China with massive losses? I need to warn you about something. China's Venezuela bet is not publicly celebrated or discussed openly in Chinese strategic communications. This is quiet, persistent, patient investment that continues despite obvious challenges because Chinese strategic planning operates on timeframes Western analysis often misses. Chinese calculation is that Venezuela has world's largest oil reserves, over 300 billion barrels. This resource is too strategically valuable to abandon, regardless of current difficulties. If China maintains presence and investment through Venezuela's crisis years, and if Venezuelan production eventually recovers, China will have secured access to massive oil supplies for decades at prices locked in through debt repayment arrangements. This is multi-dead bet that accepts short-term losses for potential long-term strategic energy security. But the risks are real. Venezuela might never stabilize. Production might never recover. Chinese investment might be lost entirely. And political instability could erase Chinese economic presence. Let me start with how China got into this situation, because the history explains the current dilemma. China began lending to Venezuela heavily in the 2000s under Hugo Chavez. Venezuelan oil production was strong. China needed energy supplies. The arrangement was simple. China lends billions. Venezuela repays with oil deliveries. This worked when oil prices were high and Venezuelan production was stable. China got oil at agreed prices. Venezuela got Chinese financing without IMF conditions. Win-win. But Venezuelan economy started collapsing around 2014, 2015. Oil prices fell from over $100 per barrel to under $50. Venezuelan government spending was based on high oil prices. When prices fell, fiscal crisis hit. Worse, Venezuelan oil production began declining. Underinvestment in fields, maintenance deferred, equipment failures, brain drain as skilled workers fled, corruption and mismanagement. Production fell year after year from 2.5 million barrels daily in 2015 to under 1 million by 2020. China was already deeply invested tens of billions in loans. Oil for loan arrangements meant Venezuela was delivering oil to China, but at volumes below what was needed to repay loans because production was falling. Chinese choice was cut losses and walk away, losing the money already invested and getting no more oil, or continue supporting Venezuela, hoping production would stabilize and eventually recover. China chose to continue, not enthusiastically, but pragmatically. The money was already gone unless Venezuela recovered. Walking away guaranteed total loss. Continuing meant possibility of eventual recovery. By 2018 to 2020, when Trump administration increased sanctions on Venezuela dramatically, Chinese companies faced legal risks operating there. U.S. threatened secondary sanctions on entities dealing with Venezuelan oil sector. Many international companies pulled out. China continued operating despite risks. Chinese state-owned oil companies, particularly CNPC and CIPC, continued technical cooperation with PDVSA. Chinese oil service companies continued working in Venezuelan fields. Chinese financing continued flowing, though more carefully structured. By late 2025, China is the only major player still significantly invested in Venezuelan oil sector. Everyone else left. China stayed because walking away meant losing everything already invested. This is sunk cost fallacy at massive geopolitical scale. But it's also strategic calculation that Venezuelan resources are too valuable to abandon if there's any possibility of recovery. Now, let me tell you what China is actually getting from Venezuela by late 2025, because the current returns reveal why this is losing proposition without future recovery. Venezuela delivers approximately 400,000 to 500,000 barrels daily to China as of late 2025. This is payment for previous loans and current Chinese support. Some goes to Chinese state refineries, some is re-exported by China to other markets. At $70 per barrel average price, $450,000 barrels daily equals roughly $31 million daily, or $11.5 billion annually. That sounds substantial, but remember, China invested $60 billion to $70 billion. At $1.5 billion annual recovery, it takes 6 to 7 years just to recover principal, assuming no interest and no new investments. But China is making new investments, more loans, more equipment, more support. So the net recovery is far less than $11.5 billion annually, maybe $5 billion to $8 billion net. At that rate, recovering the $60 billion to $70 billion investment takes 10 to 15 years, assuming current delivery levels continue, and there's no guarantee deliveries continue at current levels. Venezuelan production is fragile, facilities are old, maintenance is minimal, production could decline further without significant new investment. So China's current return on investment is negative, losing money year after year. The only way this becomes profitable is if Venezuelan production increases dramatically from current 700,000 to 800,000 barrels daily to 1.5 million or 2 million barrels daily. And if China captures significant portion of increased production through debt repayment arrangements, this is why China is doubling down. Current situation is losing proposition. Only way to win is by making Venezuelan recovery happen through continued investment. Let me show you what Chinese companies are actually doing in Venezuela by late 2025, because the operations reveal the scale of Chinese commitment. Chinese state oil companies, primarily CNPC, operate in Venezuelan Orinoco Belt. This is where most of Venezuela's proven reserves are, extra heavy crude that requires special processing. CNPC has joint ventures with PDVSA developing Orinoco fields. These operations by late 2025 continue despite difficulties. Chinese technical personnel are in Venezuela. Chinese equipment is being used. Chinese financing supports operations. Production from these fields goes primarily to China as loan repayment. Chinese oil service companies provide drilling, maintenance, technical services. Venezuelan state company PDVSA lacks technical capacity and funding. Chinese companies fill the gap, providing services in exchange for future oil deliveries or payment. Chinese equipment manufacturers supply Venezuela with oil field equipment, refinery equipment, drilling rigs. Venezuelan ability to maintain production depends significantly on Chinese equipment supplies because Western suppliers mostly exited due to sanctions. Chinese banks, primarily China Development Bank, continue providing financing to Venezuelan government and PDVSA. These loans are structured as oil-backed. Venezuela commits future oil production to repay loans. Effectively, China is pre-purchasing Venezuelan oil at discounted prices years in advance. Chinese shipping companies transport Venezuelan crude to China. Direct shipments, sometimes using Chinese-owned tankers to reduce sanctions exposure. The logistics of getting Venezuelan oil to China, despite U.S. sanctions pressure, requires Chinese control of supply chain. All of this creates deep Chinese operational presence in Venezuelan energy sector. It's not just financial loans, it's comprehensive involvement in production, processing, transport, sales. China is embedded in Venezuelan oil industry. By late 2025, Venezuelan oil sector depends on Chinese presence. Without Chinese equipment, technical expertise, financing, Venezuelan production would likely fall below 500,000 barrels daily or less. China keeps Venezuelan oil flowing. Now let me tell you about U.S. sanctions dimension, because this complicates everything and reveals Chinese risk calculation. United States has comprehensive sanctions on Venezuela targeting oil sector specifically. American companies cannot operate in Venezuelan oil. Foreign companies operating there risk U.S. secondary sanctions. Banks handling Venezuelan oil transactions risk being cut off from dollar financial system. These sanctions are designed to pressure Venezuelan government by cutting oil revenue, but they also threaten any company, including Chinese companies, that continues operating in Venezuelan oil sector. China has largely ignored sanctions and accepted the risks. Chinese calculation is that U.S. won't impose severe secondary sanctions on major Chinese state companies because that would escalate U.S.-China tensions beyond what America wants its brinkmanship. China bets America won't follow through on sanctions threats against China. So far, this calculation proved correct. U.S. sanctioned some Chinese companies for Venezuela dealings, but hasn't imposed comprehensive secondary sanctions on major Chinese oil companies. The Trump administration in first term was aggressive on Venezuela, but stopped short of full secondary sanctions on Chinese entities. Biden administration maintained sanctions, but also didn't escalate to secondary sanctions on major Chinese companies. By late 2025, with Trump back in office, uncertainty exists about whether this restraint continues. Trump administration could decide to impose secondary sanctions on Chinese companies to pressure both Venezuela and China simultaneously. This is risk Chinese companies operating in Venezuela face. But Chinese assessment appears to be that Trump, despite aggressive rhetoric, is fundamentally transactional. If China is buying American goods, if trade relationships are managed, Trump is unlikely to escalate sanctions to the point of seriously harming Chinese major state companies. The bet is that sanctions threats remain primarily rhetorical. This could be miscalculation, but it's the bet China is making by continuing and expanding Venezuela operations by late 2025. Let me show you what success looks like for China's Venezuela bet, because understanding the upside reveals why China continues despite risks. Success scenario: Venezuelan political situation stabilizes. Either Maduro regime consolidates or transition occurs to government willing to work with China. U.S. sanctions are eventually lifted or eased as political situation changes. With political stability and reduced sanctions, international oil companies return to Venezuela. Technology and capital flow in. Venezuelan production begins recovering. Increases from current 800,000 barrels daily to 1 million barrels daily by 2027, then 1.5 million by 2029, eventually approaching 2 million or more by early 2030s. China, as largest creditor with deep operational presence, captures significant portion of increased production, maybe 600,000 to 800,000 barrels daily flowing to China at prices locked in through debt repayment arrangements at 700,000 barrels daily. That's $18 billion annually at $70 per barrel at $18 billion annual inflow. China recovers the $60 billion to $70 billion investment in 4 to 5 years. After that, continued discounted oil flows for another decade or more represent pure profit. Total return could reach $150 billion to $200 billion over 15 to 20 years. This would be massive strategic victory. China secures access to significant portion of world's largest oil reserves at favorable prices for decades. Energy security enhanced enormously. The $60 billion to $70 billion investment becomes one of most successful Chinese strategic bets. This is what China is gambling on, not certain but possible, if Venezuelan recovery occurs. And the upside is large enough that China judges the continued investment is worth the risks. But let me show you what failure looks like, because the downside is also massive. Failure scenario: Venezuelan political situation doesn't stabilize. Maduro regime continues, but economy continues declining. Production continues falling or stays at current low levels. U.S. sanctions remain indefinitely. Chinese companies continue operating in hostile environment with minimal returns. Venezuelan debt to China grows as China continues providing support just to maintain current minimal production. By 2030, Venezuela might owe China $30 billion or more with no realistic prospect of repayment. Eventually, political change occurs in Venezuela. New government repudiates debt to China, nationalizes Chinese assets, kicks out Chinese companies. China loses not only the original $60 billion to $70 billion, but additional billions invested through 2020s, trying to recover original investment. Total Chinese losses could reach $80 billion to $100 billion. This would be one of China's largest foreign investment failures, comparable to Belt and Road projects in Pakistan or Sri Lanka that face difficulties, but at larger scale. Additionally, failure would damage Chinese credibility. Other countries watching Chinese Venezuela bet would learn that China's patient capital can be lost entirely if countries refuse to honor obligations. This could affect Chinese Belt and Road lending to other risky countries. The downside is real and large. China could lose everything by late 2025. This possibility is substantial. Venezuelan recovery is uncertain. Political stability is not assured. Production increases are not guaranteed. But China continues betting, because the alternative, walking away now and guaranteeing total loss, is also unacceptable. Now, let me tell you what global consequences are if China's bet succeeds, because success reshapes energy markets. If Venezuelan production recovers to 2 million barrels daily or more with significant portion flowing to China at favorable prices, Chinese energy security improves dramatically. China's dependence on Middle East oil decreases. China has more diversified oil supply, including large amounts from Venezuela, plus existing supply supplies from Russia, Middle East, Africa. This energy security reduces China's vulnerability to potential oil embargoes or supply disruptions. In any major conflict scenario, China, Taiwan, or broader, China's energy supplies are less vulnerable if Venezuela provides 600,000 to 800,000 barrels daily that cannot be easily interrupted. Global oil markets shift. Venezuela adding 1 million to 1.5 million barrels daily to global supply, with much of it going to China, affects global oil prices and flows. OPEC faces more competition. Prices potentially decline if Venezuelan supply increases significantly. Middle East oil producers face reduced market share. U.S. energy strategy is affected. Venezuela was meant to be a cautionary tale about failing under authoritarian mismanagement. If China's support enables Venezuelan recovery, the narrative flips. China's patient strategic investment succeeds where U.S. sanctions and isolation failed. This affects how developing countries view Chinese versus American approaches. Latin American geopolitics shift. Venezuelan recovery with Chinese backing would demonstrate Chinese influence in America's hemisphere is durable and effective. Other Latin American countries might be encouraged to work more closely with China. American influence in region would be seen as declining. These consequences make Chinese bet on Venezuela strategically significant beyond just bilateral China-Venezuela relationship. Success changes energy markets and geopolitical alignments globally. But let me show you the consequences if China's bet fails, because failure also has global implications. If China loses $80 billion to $100 billion in Venezuela, Chinese foreign investment strategy faces scrutiny. Belt and Road Initiative faces questions about whether China's patient capital approach works or leads to massive losses. Chinese lending to risky countries might be reduced, affecting development finance globally. Venezuela failing despite Chinese support would validate U.S. sanctions approach demonstration that sanctions can work even when major power tries to undermine them. This could encourage U.S. to use sanctions more aggressively against other countries, believing that even Chinese support won't save them. Chinese credibility as alternative development partner would be damaged. Countries considering Chinese financing would look at Venezuela and question whether Chinese backing is reliable. If things go wrong, this could reduce Chinese influence in developing world. Energy markets less affected because Venezuelan production remains low regardless of Chinese investment. But the geopolitical message would be that Chinese strategic bets can fail spectacularly, reducing perceived Chinese effectiveness as global power. The failure consequences are significant for Chinese global positioning, even if energy market impacts are limited. China's growing bet on Venezuela by late 2025 is high-risk energy move with global consequences regardless of outcome. Success means Chinese energy security dramatically improved. Venezuelan production recovered and Chinese strategic patience validated. Failure means massive financial losses, credibility damage, and validation of U.S. sanctions approach. By late 2025, China is doubling down despite 15 years of losses because the sunk cost is too large to abandon without trying everything possible to achieve recovery. The $60 billion to $70 billion already invested is lost unless Venezuelan production recovers. So China continues investing more, betting that persistence will eventually pay off. This is strategic gamble operating on decades-long timeline with billions at stake. Chinese calculation is that Venezuela's 300+ billion barrels of oil reserves are worth the risk. That eventual recovery, even if delayed, makes continued investment rational. That walking away guarantees loss while staying means possibility of success. By late 2025, the bet continues. Chinese companies operate in Venezuela despite sanctions risks. Chinese financing flows despite years of negative returns. Chinese technical expertise props up Venezuelan production despite operational difficulties. Global consequences wait on whether BET pays off or fails. Energy markets, geopolitical alignments, development finance approaches, Chinese credibility as strategic investor, all affected by whether China's Venezuela gamble succeeds or becomes expensive failure. The bet is made. The stakes are enormous. The outcome is uncertain. And By late 2025, China is all in on Venezuela regardless of risks. Think about what it means when you've invested so much that success is only way to avoid catastrophic loss. So you keep investing more, hoping eventually the bet pays off. That's China's Venezuela position. Growing bet, high risk, global consequences waiting, and no exit strategy except success or total loss.